Hi everyone, welcome to Chapter 7. This is the Cengage Managerial Accounting text. This week we talk about variable costing for management analysis. So, variable costing versus absorption costing. Under the absorption costing, the cost of goods manufactured includes direct materials, direct labor, and the factory overhead cost. It includes both fixed and variable costs as part of factory overhead. So as you see, under absorption costing, we would see our sales, our cost of goods sold, which then gives us our gross profit. Then once we have our selling and admin, we would get our operating income. But under variable costing, which can also be called direct costing, the cost of goods manufactured only includes the variable portion of the manufacturing costs. The cost of goods manufactured are the direct materials, direct labor, and the variable factory overhead. The fixed factory overhead costs are not a part of the cost of goods manufactured in variable costing. The fixed factory overhead in variable costing are treated as period expenses, not product expenses. Manufacturing margin is what we show the excess of sales over variable cost of goods sold. Variable cost of goods sold are the direct materials, direct labor, and the variable factory overhead for those units sold. We get the contribution margin, which is the excess of the manufacturing margin over the variable selling and admin expenses. Then subtracting those fixed costs from our contribution margin will equal our operating income. Here you see the difference between the absorption costing and the variable costing. You see in variable costing, the fixed factory overhead will be a period expense. So to look at it by assuming that Martinez manufactures 15,000 units, which are sold at a price of $50, the related costs and expenses for Martinez are shown here. Under our manufacturing cost, we've got our variable and we've got our fixed for total manufacturing cost, and then we have our selling variable and fixed selling and admin. And as you see here, the absorption costing does not distinguish between variable and fixed costs. All manufacturing costs are included in the cost of goods sold. So deducting the cost of goods sold of $525,000 from the sales of $750,000 yields gross profit of $225,000. Deducting selling and administrative expenses of $125,000 from gross profit yields operating income of $100,000. Variable costing income reports variable costs separately from those fixed costs. Deducting the variable cost of goods sold of $375,000 from sales of $750,000 yields the manufacturing margin of $375,000. Deducting variable selling and administrative expenses of $75,000 from the manufacturing margin yields the contribution margin of $300,000. Then deducting fixed cost of $200,000 from the contribution margin yields operating income of $100,000. Operating income is going to vary between the absorption and variable methods. And it's going to depend on whether there are changes in inventory. If the units manufactured equal the units sold, then there won't be a change. But if the units manufactured exceed the units sold, there's going to be an increase in inventory. Or if the units manufactured are less than the units sold, then there's going to be a decrease in inventory. When the amounts manufactured equal the ones sold, then operating income is going to be the same under the methods. But when manufactured units that are manufactured exceed those units sold, then the variable costing operating income is going to be less than for absorption costing. And the opposite is true. When the units manufactured are less than the number of units sold, the variable costing operating income is going to be much greater than that for absorption costing. When units manufactured exceed the units sold, the variable costing income is going to be less. Assume that only 12,000 of the 15,000 units Martinez manufactured were sold. This difference in operating income is due to the fixed manufacturing cost. All of the 150,000 of fixed manufacturing cost is included as a period expense in the variable costing statement. However, the 3,000 units of ending inventory in the absorption costing statement include 30,000. That's the 3,000 units at $10 of the fixed manufacturing cost. By being included in inventory, this 30,000 is excluded from the cost of goods sold. So the absorption costing operating income is 30,000 higher than the operating income for variable costing. Now, if we assume that beginning inventory, units manufactured and units sold for Martinez are shown here, we have a 5,000 beginning inventory, units manufactured are 10, and then the units sold are 15, and we see the variable expenses, then this is going to be a different scenario. This slide here shows a $50,000 difference in operating income. This difference is because of the fixed manufacturing costs. The beginning inventory under absorption costing includes 5,000 units at $10 of fixed manufacturing cost that were incurred in the preceding period. By being included in the beginning inventory, this 50,000 is included in the cost of goods sold for the current period. Under variable costing, this 50,000 was included as an expense in the income statement for the prior period. So the variable costing operating income is going to be 50,000 higher than the operating income for absorption costing. Here you see, if the number of units manufactured is equal to the number of units sold, all's going to be fine. But if the units manufactured are greater than the units sold, then our absorption costing income is going to be greater than variable. If the units manufactured are less than the units sold, then our variable costing operating income is going to be greater than under absorption costing. So our first check here under variable costing, fixed factory overhead costs are considered period expenses. The only portion that gets put under cost of goods sold will be the variable fixed factory overhead costs. Okay. Next, let's look at how we'll go about looking at operating income under these two methods. Assume that Frand Manufacturing has no beginning inventory and sales are estimated to be 20,000 units at $75 per unit. Also assume that sales will not change if more than 20,000 units are manufactured. So our proposal under this method is 25,000 units to be manufactured and 20,000 units would be sold. If Frand manufactures 25,000 units, sells 20,000 units, and adds the 5,000 units to finished goods, which is the proposal 2, operating income will be 280,000. But if Frand manufactures and sells 20,000 units, which is proposal 1, operating income will be 200,000. So Frand can increase operating income by 80,000 by simply increasing finished goods inventory by 5,000. Managers have to be aware of analyzing operating income under absorption costing when finished goods inventory changes. Increases in operating income are created by simply increasing the finished goods inventory. So managers could misrepresent increases or decreases in operating income based on sales volume changes or prices or costs. In this example, under variable costing, operating income is 200,000, regardless if 20,000 units or 25,000 units get manufactured. This is since no fixed manufacturing costs get allocated to the units manufactured. All fixed manufacturing costs get treated as a period expense. So as you see here, the absorption costing encourages managers to produce inventory. This is because producing inventory absorbs fixed manufacturing costs, which increases operating income. But producing inventory leads to higher handling costs, storage costs, financing costs, and potentially obsolescence. So for that reason, many accountants believe that variable costing should be used by management for evaluating operating performance. Here, when absorption costing increases, when using absorption costing, increases in operating income may be created by increasing our finished goods inventory. So we're going to take a look at some exercises here just so we can gain an understanding of these methods here. At the end of the first year of operations, 18,000 units remained in the finished goods inventory. The unit manufacturing cost during the year are shown here. Direct materials of 25, direct labor of 20, fixed factory overhead of 30, and variable factory overhead of 5. We're going to determine the cost of finished goods inventory that are shown in the balance sheet using both those methods. So if we use the absorption method, our fixed factory overhead costs would be included in our ending inventory. So we would have our direct materials, we would have our direct labor, our fixed factory overhead, and our variable factory overhead for $80 per unit. At 18,000 units would be $1,440,000. But under variable costing, we are not going to take that fixed overhead, factory overhead, and put it in a part of the inventory. That gets expensed. So then our costs are only $50 a unit, which a total of that 18,000 units at 50 is only $900,000. All of the fixed factory overhead costs get expensed in the variable costing income statement as a period expense. This exercise, Crazy Mountain Sports, assembles and sells snowmobile engines. The company began operations on March 1st and operated at 100% capacity during the first month. The following information summarized the results for March. So we've got our sales at 12,500 units, our production costs of 15,000 units, and then we've got our various selling and admin expenses. So the first thing we're going to do is prepare an income statement under absorption, then under variable, and talk about what the differences are. Remember, absorption, all costs stay with the inventory until they're sold. So under absorption, our cost of goods sold are going to include our direct materials, our direct labor, both our variable and our fixed overhead. So that's $260 per unit. Since we sold 12,500 units, our cost of goods sold here is $3,250,000, which gives us operating income here of $2,830,000. Now, under the variable costing, you see our variable cost of goods sold on the 12,500 units is only $220 because we're not taking into account the fixed overhead. That $40 per unit we're not including there. That will be put in period expenses. So we've got our sales less our variable cost of goods sold gives us our manufacturing margin. Then we take our variable selling and admin to come up with our contribution margin that gets applied towards our fixed expenses. We show our fixed factory overhead, our fixed selling, to come up with operating income here, in this case of $2,730,000. The difference between the two methods is shown. The increase in inventory of 2,500 at that fixed of $40 per item, that 100,000 is added to our operating, or is subtracted in order to get to our operating income. So under that absorption method, that fixed factory overhead included in the cost of goods sold is matched with revenues. So the 2,500 units that were produced but not sold, that are still sitting in inventory with that fixed factory overhead of 100,000, isn't part of cost of goods sold. It's part of inventory on the balance sheet. However, under variable costing, all of that fixed factory overhead cost gets deducted in the period. And so we're going to have a period cost, which as a result, even though they weren't sold, but because they were manufactured in that period, is going to provide lower net income under, or operating income under, variable costing. Here we've got Fresno Industries that manufacture and sell high-quality camping tents. The company began operations on January 1st and operated at 100% of capacity during the first month, creating ending inventory of 20,000 units. Then during February, the company produced 130,000 units during the month, but sold 150,000 units. And the February manufacturing cost and selling are shown over here. So in the first month, they manufactured 150 and they sold 130 of them. Then in the second month, they they manufactured 130, but they sold 150,000 units. So we're going to prepare an income statement using the absorption method for 2 months. Then we'll do it using the variable method. So for 2 months here, we've got the same sales. Using the absorption method, we're going to show the inventory and the cost of goods manufactured. All of that. Cost of goods sold here is $45,670 for a gross profit under the absorption method of $29,330,000. Then we've got our selling and admin to give us operating income of $26,135. With the variable method, we've got the variable cost of goods, the 150,000 units at $275 a unit, which gives us our margin. Then we take our variable selling and admin, which then give us our contribution margin that then is applied to our fixed cost. So we've got the fixed manufacturing cost of $3,900,000 and our fixed selling to show operating income of $26,655,000. Now, what the difference is between the absorption income and the variable income is the beginning inventory. You see that the beginning inventory, we've got the 20,000 units, fixed manufacturing cost of $26. That's what's giving us our difference in our operating income for the month of February. Under the absorption costing concept, the fixed manufacturing cost included in the cost of goods sold is matched with revenues. As a result, 20,000 units that were produced but unsold in January, beginning inventory of February 1st included fixed manufacturing cost, which is included in the cost of goods sold for February. But in variable costing, all of the fixed manufacturing cost is deducted in the period in which it is incurred, even no matter how the amount of inventory changes. So when inventory decreases, the absorption costing income statement will have lower operating income than the variable costing statement will. Now, each situation needs to be looked at in deciding which is more useful. Is variable costing more useful or is absorption costing? The use of absorption and variable costing in the following decision-making situations here we're going to look at. So, what's better? Well, since variable costing reports variable and fixed costs and expenses separately, it's often more useful than absorption costing for setting short-run prices. In the long run, a company must set its selling price high enough to cover all costs and expenses, the variable and the fixed, and generate operating income. Since absorption costing includes fixed and variable cost in the cost of manufacturing a product, absorption costing is often more useful than variable costing for setting long-term prices. In the short run, planning production is limited to the existing capacity, and decisions need to be made quickly. In the long run, planning production can include expanding existing capacity. So when analyzing and evaluating long-run sales and operating decisions, absorption costing can be more beneficial. A market segment is a portion of a company that can be analyzed looking at the sales, costs, and expenses to determine its profitability, such as sales territories or products. So, which of the following would not be considered a market segment that a company could use to analyze profitability? The production costs. Let's look at, I'm going to keep going on here. I don't think I have exercises for 3 there. Let's look at market segments. Absorption costing is beneficial for long-term decision making. Variable costing is beneficial for that short-term decision making. Most companies prepare variable costing reports for each product and use the reports for product pricing. Here we have Camelot Fragrance. We've got 2 products, and we show the sales and the various costs for each of them. Now, this slide indicates that Lancelot's contribution margin ratio of 58% is greater than Guinevere's ratio of 38%. Lancelot's higher contribution margins are a result of its lower promotion and sales commission costs. So, management may consider emphasizing Lancelot in its marketing plans, or maybe reducing Guinevere's promotion and sales commission cost, or could they increase the price of Guinevere? So, what's the impact of a higher contribution margin ratio on one product, and how does that affect the company? Selling more Lancelot products will speed up the process of covering the fixed expenses. For the Guinevere product line, the company only gets 38 cents towards covering its fixed expenses, where with the Lancelot product, it gets 58 cents towards those fixed expenses. Let's take a look at some problems here, guys. So I want to look at this one here. Watham Industries employs 7 salespeople to sell and distribute its product throughout the state. Data taken from reports received from the salespersons during the year ended show, so we've got the various salespeople, we've got their total sales, their variable cost of goods sold, and their variable selling expenses here. Prepare a table indicating the contribution margin, the variable cost of goods sold as a percent of sales, the variable selling expenses as a percent of sales, and contribution margin ratio by salesperson. And then we're going to look at which salesperson generated the highest contribution margin ratio and why, and factors that could be considered in evaluating the performance of these sales individuals. So, here, sales for 8. Let me get in here. I'm so sorry. I want to go down here. Okay, here we go. So we've got the various salespeople, and we've got their contribution margin, their variable cost of goods sold as a percent of sales. We've got the variable selling as a percent of sales, and the contribution margin ratio. So you see here, Orcus has a 50% contribution margin for the year. Orcus has the smallest variable cost of goods sold as a percent of sales. Maybe he's got a good mix of product that has high manufacturing margins. And he's got the lowest variable selling expenses. This could be because he's got a lower sales commission, or he might have a smaller cost in selling his products. Now, other factors that we need to look at could be rate of growth in sales for the current year over past years, years of experience, size of the territory, and what the actual sales are compared to those budgeted sales. I'm going to go back and look here at some other exercises. Oops, I want to take it here. Okay. Let's look at exercise 710. Fleet of Foot Inc. manufactures and sells 3 types of shoes. The income statement prepared under the absorption costing method is shown right here. Okay, so that might be just a little too big, but you see the cross-training shoes, the revenues are $12 million with our cost of goods sold and our selling and admin. We've got a loss here of $240,000. Our golf shoes show a profit of $3.5 million, and our running shoes show a profit of $1,390,000. In addition, we've determined the following information with respect to allocated fixed cost. So we see these fixed costs of the cross-training shoes of $1,800,000 and the selling and admin of $1,440,000. We see the fixed cost of golf and the fixed cost of running shoes. Now, these costs are used to support all 3 product lines, will not change with the elimination of any one product. In addition, you have determined that the effects of inventory can be ignored. The management of the company has deemed the profit performance of the cross-training shoe line is unacceptable. As a result, it's decided to eliminate cross-training. Management doesn't expect to be able to increase sales in the other 2 lines. So as a result of eliminating the running shoe line, management expects the profits of the company to increase by $240,000. Is that true? And let's look at a variable costing for this scenario. Okay? So let me pull up the solution here. There we go. So that's not necessarily the case here. The profit's not going to be better because the fixed cost aren't going to be avoided. Even though they eliminate the shoe line, and they're not going to eliminate the fixed costs. So those fixed costs totaling $3,240,000 for the cross-training shoe line are still going to be there. The actual profit is ultimately going to go down by $3 million if they eliminate the training shoe line. So if you look here at the various providing a variable costing, we show our revenues and the cost of goods sold. We're only showing our variable cost of goods sold here. We've got our manufacturing margin. We take our variable selling and admin expenses to come up with our contribution margin. Then, if we take our fixed cost here as a period cost, here you see the cross-training shoes would show an operating loss here of $240,000. Golf shoes would be a profit of $3,500,000, and running shoes $1,390,000. If those cross-training shoes were eliminated, then the contribution margin of the product line would be eliminated, but the fixed costs aren't going to be eliminated. So the profit of the company basically is going to go down by $3 million. Ultimately, somehow they need to find a way to improve the profitability of the line, either by increasing prices or volume, or somehow trying to reduce costs there. Okay, let's look at our product profitability. Galaxy Sports manufactures and sells two styles of all-terrain vehicles, the Conquistador and Hurricane. All come from one facility. The manufacturing facility operates at 100% capacity. The following per unit information is shown: Conquistador versus Hurricane. In addition, the following sales unit volume information for the period is shown. Prepare a contribution margin by product report. Compute the contribution margin ratio for each, and what advice would you give? So, let's look here. Here we go. So, we've got our sales of the Conquistador and of the Hurricane, our variable costing, we've got our manufacturing margin, our variable selling and admin, and our contribution margin. So our contribution margin for the Conquistador, the $15 million divided by $60 million is 25%, whereas the Hurricane's at 40%. So the Hurricane line provides the largest contribution margin and the largest contribution margin ratio. If the sales mix could get shifted a little more favorable for the Hurricane, profitability of the entire company would go up in that case. Let's look at this one. Pipeline Surfboards manufactures and sells two styles of surfboards, the Atlantic Wave and the Pacific Pounder. These surfboards are sold in the East Coast and the West Coast. And we've got the sales price, the variable costs, the variable selling expenses per unit, and the contribution margin. And here we've got the sales unit volume for each. We're going to prepare a contribution margin and the margin ratio. And what do we come up with? So in this case, we can see the sales for the East Coast is 40 million less our variable cost of 24 million. Gives us our manufacturing margin of 16 million. After our variable selling expenses, we've got a contribution margin of 10 million, which is a 25% margin ratio. The West Coast, you can see here, has a higher contribution margin and a higher contribution margin ratio. So the total contribution margin is lower for the East Coast because the East Coast sells the Atlantic waves, which ultimately has a lower contribution margin. The contribution margin is 5% lower. Even though the East Coast sells a lot more surfboards than the West Coast does, the East Coast can't make up for the West Coast higher contribution margin. So changing mixes aren't going to really affect the profitability. The East Coast will sell few Pacific Pounders just because of the style of surf. Even though the Pacific has a mixed surf, they want to sell that West. They're looking better on the West Coast. The selling price of the Atlantic Wave is lower than the Pacific Pounder. Why is it? Could possibly that price be increased, which would then help the manufacturing margin? So those are just all things to consider in analyzing how this works. Okay. Let's just do one more. The Walt Disney Company is a global entertainment company, and it has media networks, and parks and experiences, and studio entertainment, and then streaming services. For a recent year, Disney reported the following segments in millions. So our media networks had operating income of $9,022,000. Parks had a loss. Studio and entertainment had $2,501,000. And the direct-to-consumer media or streaming had a loss. Assuming the following percentage of total operating expenses for each segment are variable. So we've got our various media networks is at 75%, parks 60%, studio entertainment is at 80%, and direct-to-consumer and international sitting at 70%. Prepare a variable costing income statement for the Walt Disney by segment. Compute the contribution margin for each segment and what happens here. So we see the costs here, and now we see the portion that is variable. So let's look at this exercise here. There we go. So to look at this, we just break out the variable operating expenses for the 4 different segments to come up with our contribution margin. And then the rest will go into period costs. So our figures, our bottom lines here are all going to stay the same. But when we look at the contribution margin ratio for MediaWorks, it's sitting at the highest number, 48.8%, Parks 39.7%, Studio 40.8%, and Direct to Consumer at 18.4%. All of these are supporting a positive contribution margin, even though there are some losses. The media networks had the highest contribution margin of 48.8%. Because of the size of the parks experience, even though the contribution margin wasn't as high, just their pure volume really helped to pay for fixed expenses. The direct to consumer and international segment had the lowest contribution margin and the lowest ratio and the lowest margin. COVID probably harmed that piece. So what can we look at? Ultimately, normal operations probably wouldn't be this way, but as a result of everything that's happened with COVID, that's probably why these numbers are being affected in the manner that they are. Okay, let's move back to the PowerPoint and finish up here. Variable costs for a service business. We can use this same process for service companies. Since there isn't really physical inventory, most service companies do use variable costing. Costs are classified as fixed or variable based on how it is changed as a result of the activity base. Most service companies might use several activity bases. An airline uses the number of passengers for food and beverage service, and selling expenses might use the number of miles flown for the fuel or for the wages. So here we see the various expenses for Blue Skies. So in this case, unlike a manufacturing company, this slide doesn't report cost of goods sold or inventory or manufacturing margin. But a contribution margin is reported separately from the operating income. Here we see various service industries, various segments. Electric power. We could look at regions or customer types. Banking, customer types or products. Airlines could be products or routes. Railroads could be products or routes. Hotels may be the type of properties. Telecommunications could be types, customer types or service types, and then healthcare could be various types of procedures or payments. So a contribution margin report for service companies can look at various market segments. A contribution margin report segmented by route for the airline might show the various routes and the price per ticket. Here we've got the various routes, the Chicago-Atlanta or Atlanta-LA or LA-Chicago. And we see our various price, number of passengers that were served, and the miles flown. And then we can come up with the variable costs. So this slide here shows that the Chicago-Atlanta route has the lowest contribution margin ratio of 25%, but the Atlanta-Los Angeles route has the highest contribution margin ratio. North America sales are approximately 61% here of total sales. International sales are at 27% of total sales, and AWS sales are at 12% of total sales. So the international and AWS segments, even though they're smaller, are still going to be significant. Here we've got North America has an EBITDA of 6.4% of sales, where the international and AWS segments have 2.8 and 46.6. So that AWS segment's got the highest contribution margin, followed by the North America segment. So this earnings before interest, taxes, depreciation, and amortization, is it a valid way to compare segment performances? Could be, might not be. It says here, some product lines or segments may have older property, plant, and equipment, so they had to have less depreciation than it would a newer item. Or a newer segment may have higher interest costs. State and local taxes can have more impact on one segment than another. So they're saying it might help in comparing apples to apples if you don't put all these other items in it. Let's look at one last problem. Okay? Let's look at Exercise 717, variable costing for a service company. East Railroad Company transports commodities among 3 routes: the Atlanta-Baltimore, the Baltimore-Pittsburgh, and the Pittsburgh-Atlanta. Significant costs, their cost behavior and activity rates are shown here. And then we've got various operating statistics regarding the number of train miles, the number of rail cars, and the revenue per rail car. So we're going to prepare a contribution margin by route, compute the contribution margin ratio, and let's look at the performances. So here we show the revenues from Atlanta to Baltimore is $255,000. Baltimore to Pittsburgh, $594,000, and Pittsburgh to Atlanta, $542,080. We've got our variable labor costs, the fuel costs, the train crew labor costs, and the switch yard. So here you see the contribution margin ratio, a minus 11.5% for Atlanta-Baltimore, 38.3% for Baltimore-Pittsburgh, and Pittsburgh to Atlanta was 31.6%. The Atlanta-Baltimore route performs the worst. It runs few rail cars, has high mileage. The railroad's running many short trains on this railroad. The railroad's profitability must be sensitive to the size or length of the train in rail car terms, where a short train costs almost as much fuel and crewing as a longer train, so they're going to be less profitable, where the other two routes have much better ratios. Yeah, this is really interesting, and it's true. In universities, real large classes are going to be, of course, a lot more profitable. Full airplanes are absolutely more profitable. I mean, it's just makes total sense. Well, guys, there you have it. I hope that's been helpful. Hope you have a wonderful week, and I'll see you next week.